and welcome to another daily dose of insights powered by Container Exchange. My name is Christian, and every other day we bring to you the key news, stories, and data points that move container markets and hence your business. Today is Friday. We're trying to coin every day with a name, so this we call Fundamental Friday, where we talk a little bit about fundamental shifts within the shipping economy, primarily looking at, of course, freight rates, prices, and capacity. Let me quickly share my screen to give you a little bit more background. Three core themes for today. Number one, I read a very interesting article or viewpoint by Zenita talking about friendshoring in action. So they essentially looked at the data and conclude that friendshoring, so essentially moving a production capacity to more friendly-minded nations, or actually countries that are more in line with a country's specific values or norms, actually shows up in the data already. What they primarily looked at was the shift in inbound container volume into the US from countries like China as well as Vietnam. And what they see is that there's a relative shift towards Vietnam as a so-called friendly nation vis-a-vis China. This also shows up in foreign direct investment, with much less or the downfall in foreign direct investments into China compared to other Southeast Asian nations. Now, my question, of course, is whether that is a fundamental, whether that fundamental shift is driven by friendshoring, so relatively new phenomena, or whether it's actually the longer-term trend towards a more cost-efficient sourcing, because as we seen the past couple of years, China has become relatively more expensive compared to other Asian peers, and hence Vietnam is more cost competitive. So it makes sense that there is an increase in import volumes and foreign direct investments into Vietnam. Also, Vietnam, of course, starts from a much lower base than China, so it wouldn't be surprising that there's a higher volume or percentage shift from there. So I'm still a little bit skeptical whether we really already see this friendshoring in action in the data. I think the longer-term trend of driving towards supply chain resilience by diversifying your supply chain, that is intact. That's a trend. But I don't think that we see this in the data already. These things just take a lot longer in terms of shifting production capacity, et cetera, et cetera. I think an indicator that this is in action, we've seen a couple of days ago with a headline that Apple massively ramped up iPhone production in India. So that sort of supply chain resilience move is in action there. Second topic here, jewelry. Positive news for once from the freight rate side, at least for the carriers. Freight rates are stabilizing. Positive rate movements on selected trades, specifically Asia-US. So both to the West Coast and the East Coast, we see an uptick in rate movements. However, this seems to be capacity-driven, not demand-driven. So carriers have been able to pull enough or sufficient capacity from the market through blanking of sailings, as well as through suspending of entire services, to actually bring supply-demand a little bit more into balance, so that freight rates have the chance to recover. Now, if you couple that with the next headline here, with number 3, Alphaliner highlighting that box ship scrapping is actually significantly below expectations, with Q1 numbers coming in at just above 48,000 TEUs sold for scrap, with a full year expectation for 2023 of 350,000 TEU. So if you scale up the 48,000 TEU, you just arrive at roughly 200,000 TEU. So a little bit more than half of what the January forecast was for box ship scrapping. And the idea here was, of course, that we need to scrap quite a significant number of box ships or box ship capacity because there's 2.4 million TEUs coming into the market in terms of new builds. So you see significant capacity increases here. You also see that still the charter market, so for secondhand vessels and the trading market for secondhand vessels is red hot. The rates are still booming. Non-operating owners are benefiting. And for me, what this means is that the race towards market share is in full swing. Carriers are fighting for market share, ramping up capacity. And as we've said before, ramping up capacity, if there's no demand to counter that, just spells doom for freight rates. And we do see sort of a freight rate war on the horizon, at least in the second half of this year. So with that, I'll let you go into your well-deserved weekend. Thanks a lot for tuning in. Please do follow me and or Container Exchange for more of these videos and insights. Head to containerexchange.com/insights for more of this on an ongoing basis. We have a small product there that helps you make better decisions with data, but that's enough of marketing for now. Have a great weekend and talk to you on Monday. Take care.